Hello and welcome. Today you're very lucky because I'm gonna share with you three stocks which I investigated and are potentially very undervalued. So a triple digit upside in the next 2 to 3 years. That means basically almost tripling your investment. So let's see which ones they are. It's Teleperformance, Lincoln National, and Alexandria Real Estate. All three companies are in different sectors, very different. Although geographically, only Teleperformance is from Europe, whereas the other ones are USA. Now let's just see what the company does. Teleperformance is a company I covered in the previous video, only Teleperformance, and it's the well, I don't know if it's the most undervalued, but it's up there with Lincoln National. So what does the company do? It basically offers customer support that just help with some services. So for example, this is usually with mobile phone subscriptions. If you're having trouble, you contact customer support and then you get these guys. So this is basically they're running a sort of outsourcing business. So for example, if you have a car shop and you want to speak with client support, for example, uh, the company would not employ its regular workers, but it would outsource them into other countries. So if you see here, it employs workers from all over the world. You can work right now fully remote and it would pay relatively high wages. The only criteria is that you speak the language of the business. So, for example, let's say you're from Switzerland and you have a company and you would like to have customer support. You would just contact Teleperformance and they would provide you with the workers uh, below the average wage. So it's a very niche business, and no one wants to do this job, right? No one wants to be a call center, and this is why this company is so good because no one wants to go to this business, and it's a big player here. The profit margins are also quite high, and it's also diversified. It's in a lot of business. It's not only call centers. Manufacturing, it's a lot of things. So if we go forward, we can see that earnings per share 14% per year. It's BBB rated. All of the companies today are gonna be BBB rated, which is not bad, but it's not great. Like it's not AAA, but it's solid. So it's not that risky. BBB, this rating is basically credit rating. So how risky is the company? And the it's trading at 11 times PE. Right now it's around 13 times PE, so it's very cheap compared to historical trends. And the payout ratio is 36%, which means that 36% of the profits are paid out in dividends, which is very low. Most companies are above 70, 60%. So this is very a good business. And it's also rising. So I don't have the graph of the business right now, but if you would see it, you would see just like a steep, I think that's how you say it, a sharp decline in the last 2 years due to acquisitions and some other reasons. And when the company normalizes back again, which I am sure it will, it's gonna have a lot of upside potential, more than triple digit. So as I've written here, expected rate of return over 200% when we go back to 22 PE, which is which is normal for the company. The company at Corona times, I think, or a bit back, traded around 30 to 40 times PE. So right now it's 15 times PE. That's less than half. So it's quite crazy. It's a lot of potential when it normalizes. The company, nothing happened. Like there wasn't a big bankruptcy or whatever. None of its business didn't fall. So there's no reason for it to trade this low. It's just macro environment, and and investors are a bit scared because slightly because of management, and the other part is because of acquisitions. But this is normal in this kind of business. So uh, the company isn't going anywhere and it's a buy. The analysts are ranging, the price ranges are from 140 to 380, and the average is 200, like 300, where I say it's 250, and this gives us like more than over 200% rate of return. So yeah, this is the first one. The next one is Lincoln National. This is a insurance business. It's similar to the previous one. It's in terms that it's a conglomerate, meaning it has a lot of businesses, but it's a very conservative business. It's very safe. It's not risky. All of the companies I'm showing today are not risky, unless I would state so, but they're very safe. So this is, although they are BBB rated, this is not a bad rating. This is a very solid, very risk-free rating. So uh, if you're putting money here, you can sleep at night. It's not a tech stock. It's not crypto. It's not giving to drug cartels money. It's very safe. It's a boring business basically. That's why you probably also didn't heard about this one before, because it's insurance. Who's is interested in insurance besides me? The com Okay, so let's focus. We have um 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 oh, I forgot where I was. Okay, no worries. The company, yeah, the company bottomed like recently, and we are expecting an upward reversal. This could happen anytime. I remember like a year ago or half a year ago when I was talking about Munich Re or Allianz. Those are the largest reinsurance companies in the world, and I was banging my drums all the time that you should invest in them, and they're gonna outperform when the reversal comes. And sure enough, it did. They outperformed, and they returned a lot of alpha returns. Also, Bristol Myers, or another one is Unum. You have it here in the slide. Also similar characteristics, safe, not too good rated, but it reversed sooner or later, and it was for $45 per share. Also, life insurance business. Life insurance is just companies that insure your basically your life in case of death or higher injury. So let's say that the it goes to 9 times PE, and that's upside of 70% per year, which is almost 300% rate of return in around 2 to 3 years. So let's say that if you invest 1,000, you would triple your money to be in simple terms. And the management is also very good in this company, very solid. The previous one I didn't mention, the management is like iffy, the French, but this one is very good, goodly run, managed. And the last one we have today is Alexandria Real Estate. It's also BBB plus rated, and it has a yield of 4%, the dividend yield. What does it do? It's a REIT. REITs are real estate investment trusts. So these are basically companies which buy a lot of property, a lot of property, offices specifically in this case, and then when the rents come in, they give the money back in terms of dividends to its investors. So it's like a fund. So in Slovenian, to je v bistvu nek sklad, ko kupuje vse te nepremičnine, te pisarne, skladišča, in potem ljudje najamejo te pisarne in jim devajo najemnino, ne, vsak mesec morajo plačati. In ta denar se na koncu zbere nazaj v tem skladu in se nato izplača v obliki dividend nazaj investitorjem, nam, ko smo v to dali. V tem primeru to podjetje vlaga večinoma v pisarne, v te velike nacionalke, naprimer Bristol Myers Squibb, Novartis v Sloveniji, ta res večja podjetja, ko veš, da ne bojo propadla. Okay, so back in English, they're investing more or less to the they're renting their offices more or less to big companies such as Novartis, Bristol Myers, mostly pharma companies, Illy, and so on. So let's see, the company is also based in America, like Lincoln National, and so here you can see over 90% of the tenants are actually top tier firms, publicly traded large caps. And it's also diversified. It's not only pharma, I was wrong. It's also like like offices, life science product, but it's mostly bioscience and pharmacy. Also, the name Alexandria Real Estate is based on uh, the city of Alexandria in Egypt because that was historically the city where more or less science developed. So it's based on that notion. Um, yeah, so it's a healthcare pharma REIT, and it's been here a long time. And as you can see, if you had invested here in the 90s, you would outperform the market because it delivered over 1,500%. So really good, even better than Berkshire Hathaway. So to get to the point, the thesis is absolutely a buy. The annual rate of return would be 41%. Uh, so this would this would be every year 40%. So triple digit upside. Currently it trades around $107, $109. So we would expect it to go to 190, or maybe that's the high end, 165 per share. So that would be if you divide that by 107, you would get 1.5, which is uh, 150% in around 4 years. So it's a buy. These three companies are very, very excellent. If you have the money and don't know where to put it, I would highly suggest to put it here currently. Specifically in the first two, I think the safest among the all of the three are is the Lincoln National. Then I would say Teleperformance, and lastly Alexandria Real Estate, just because it's in this sector of REITs, because real estate is currently regarded as very risky because of the interest rates and inflation. But still, I think it's safe. It's not gonna happen. I don't think nothing's gonna happen to the company. So yeah, basically that's it. I'm investing in these companies I already have and have already gained some returns, but I'm gonna invest for a couple of months more until I come to the 3% money cash reserves. So yeah, that's it. Thanks for watching and see you later.